Hello, everyone. Today on the Final Bar, I'm very excited to be joined by Marc Chaikin of Chaikin Analytics. He'll talk with us about some of the charts that are top of mind for him, trying to make sense of this market environment. Welcome to the new bull market that started this morning, as far as I can tell. And I say that with a bit of sarcasm. Yesterday was all about distribution. Today, feeling much more about accumulation, with some of the sectors like financials, industrials, energy, some of the cyclical sectors up over 3% earlier in the afternoon. It came off a bit into the close, but overall, plenty of strength. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of stock charts, using data visualization techniques, technical analysis, behavioral finance concepts to better understand investor behavior and improve our own decision-making. Our goal is to empower you to make better decisions as an investor. I hope you're able to use some of the things we discuss on this show to do that. We're going to overall look at this market environment. I think is in this environment, as with most, you have to disconnect these short-term movements, the flickering ticks, the short-term environment with the long-term trends, right? And that's why the market trend model, we talk a lot on the show every Friday, has three time components, has a long-term, a medium-term, and a short-term components. And that's meant to illustrate those different timeframes. A lot of investing and trading is based on, I would argue, the interplay of those different environments. You have this condition now where the long-term trend has certainly been overwhelmingly strong for most equities over time, and certainly for the broad equity indexes. You have had a short-term period of weakness here. We're giving back some of those gains, testing the 50-day moving average. A lot of stocks breaking down through their 50-day moving averages. But how does that relate to the overall long-term trend? We'll try to answer that question together on the show today and beyond. We have great guests on the show. I'm excited to have Marc Chaikin join us on the show once again a little later today. Next week, we have Mark Newton from Fundstrat joining us on Tuesday the 7th. On Wednesday the 8th, Gary Dean from Sentiment Timing. On Thursday the 9th, Samantha Leduc from Leduc Trading, and Jonathan Krinsky joining us back on the show next Tuesday after that, on Tuesday the 14th. Also, as a reminder, we have a holiday special running all through the month of December at StockCharts.com. You can go to StockCharts.com/special. If you have ever considered joining StockCharts as a premium member, I would encourage you to do it. Now is the time of the year to do it because it is the best price you're going to be able to get in for the remainder of the year. Also, if you are an existing member, you can renew your membership, and we'll add it on appropriately using that special deal. So to go to StockCharts.com/special to see our current special for the holidays. Let's continue on today's show with our market recap. As I mentioned, it's sort of a tale of two markets from yesterday to today. Yesterday was really all about distribution. Yesterday is when we're, breaking moving averages, we're breaking support levels, we're trying to gauge whether or not you get a follow-through day, a follow-through showing further downside. Today, you really did not get any sort of follow-through to the downside. Today was much more about mean reversion back to the upside with renewed strength for a lot of stocks and a lot of charts out there. Just gazing down at the market movers, the names, back on the upside today, having the biggest gains in the S&P. Kroger, which is an earnings name, overall has been one of the better charts. Being one of the better charts in consumer staples, granted, is a dubious honor. However, things like Costco, Kroger, probably some of the better charts that you would see there in a sector that overall has struggled very, very much. But look at the other names that are in the top 10 list of biggest gainers today. It's some of the weakest charts that we've seen up until now. Things like cruise lines, CCL, NCLH. It's gambling names, Wynn, MGM, and others. Hotels like HLT, airlines like DAL. It's the travel and tourism trade bouncing back. But don't get me wrong, right? We've talked earlier this week about the airlines charts. I think we highlighted AAII earlier this week and looking at how those had broken key support levels. So it's always important to think about these one-day movements and how they relate to the long-term trends. I don't know if I've seen enough in some of these travel names to get really excited about getting back in, but I have to notice on a chart like MGM or anything where you're seeing a potential, a bullish candle pattern, right? Where you're seeing, closes above the previous highs, signs of short-term accumulation. And again, short-term accumulation can often turn into long-term accumulation, but you have to see a string of those days, and you have to see key levels that are broken to validate that. The S&P, by the way, is up 1.4% as of the close. We talked about 45.50 as being a key level. We closed below there yesterday. We're closing back above it today. So 45.50, I don't know if you could say that that is completely broken. They're certainly not validated as a break after today's bounce. The NASDAQ Composite and NASDAQ 100 up a little less than the S&P 500. Technology was actually one of the worst performers in the 11 S&P sectors, although it was up almost 1% using the XOK. Mid caps and small caps both up almost 3% today. So, about doubling the returns of the S&P just on today's trading. Other asset classes very quickly, interest rates moving a little bit higher, although it was kind of mixed, to be honest with you. If you look at the 10-year yield, ending the day around 145, 30-year yields, the long bond yield actually finished down for the day and was a little bit below yesterday's close. All of them sort of, pushed higher through the course of the trading day. Commodities as a whole have had a pretty tough stretch, and I was doing a message to my market misbehavior premium members earlier today. We did our monthly chart review, and the chart of the DBC has certainly come off quite a bit. Crude oil, same thing. Both of those bouncing a little bit to the upside today. Gold, a notable outlier, actually down on the day after yesterday's retreat for most of the day for the GLD. Cryptocurrencies overall net negative, kind of a choppy session over the last 24 hours for most cryptos. Bitcoin, Ether, both below where they were yesterday when we were doing the show. Both of them had quite a movement over the course of the day yesterday. But today, really sort of a choppy digestion phase. And I usually call something a digestion phase after it's had a big move. Think of it that as your big meal. The big sell-off in Ethereum was the big meal. Now you have the digestion phase where you sort of chop around and process that before you prepare for the next move in either direction. And that's sort of the experience you're seeing with some of the major crypto, major coins that we follow. Let's look briefly at a chart of the S&P 500. And when I mentioned the lack of follow through a little earlier, this is what I'm referring to. We've keyed in for quite a while on this pink shaded area, which is right around 45.50. That was the peak that the S&P reached in early September. You see, we pulled back around 6% before eclipsing those previous highs in late October, pushing to new all-time highs. This is when the S&P got right up to around 47.50. From there, the S&P has come back and broken the 50-day moving average and broken that 45.50 level, gotten below that pink shaded area. And that was yesterday's sell-off. And we talked about on the show yesterday is anytime you have a break of a key support level, it's all about follow through, in my opinion, right? It's all about, do we follow through to the downside? Do we get some indication that the market is going to go lower? Some indication that it was not just a one-day fluke, that this is the beginning of something deeper, and you did not get that today. Today, you actually had a bit of a recovery day with the S&P opening a little bit lower, but overall through the course of the day, finishing strong. And we came a little bit off of the highs for the day, but overall, this is certainly a short-term day of accumulation, indicating at the very least a bounce off of that break of support. So you have some different conflicting narratives, I would say. On one side, you have the fact that the market's overvalued. And I hesitate to say that because I think you could have made that argument many times for many reasons along the way. And I'd much rather follow the price higher than debate why the price shouldn't go higher. That's how I would think about it. So, but you did have a bearish momentum divergence with the market making higher highs in late November, but the momentum starting to dissipate a little bit. And that has happened a number of times through the course of 2021, 3 other times that I highlighted there with those blue dashed lines. It's worth noting that in general, we had brief pullbacks earlier this year in the 3 to 5% range. And that's kind of what we've seen so far after this bearish momentum divergence. So you have that sign of negativity. Yes, some of the breadth conditions weakening. We'll talk about that with my guest, Marc Chaikin, here a little bit after the break. But then on the other side, you have the fact that we are pulling back to the 50-day moving average, which has served as support a number of times previously. You've had a number of names that have pulled back already quite a bit, right? Is that enough to register to complete that pullback phase and go higher? By the way, while we're all here, do you know what that candle pattern is? And I'm going to switch very quickly to a chart that makes it really obvious to look at the candle patterns. Anyone know what that candle pattern is? And if you don't, it's called a bullish piercing line. And I always remind people that the names of the candles are always interesting to know. I would worry a lot less about the names of the candle patterns and think a lot more about what the dynamics tell you. That bullish piercing line is when you have a long down candle, you open a little bit lower, and then you close at least 50% of the way up above the midpoint. You finish above the midpoint of that first day's candle. So big down day, big up day, and you get at least 50% of the way up. If you would go even further, that's called a bullish engulfing pattern, which is also a short-term positive pattern. This is a similar idea. It's called a bullish piercing line. So the fact that we hit the 50-day, we had this bullish candle pattern suggests short-term strength, all else being equal. What would invalidate that is basically getting below today's low. Getting down to around 4,500 would invalidate that short-term bullish candle and suggest further downside potential. So something to keep in mind when you relate the short-term movements to the long-term trends overall. I want to finish off here our market recap looking at the Mindful Investor Live chart list. So this is the chart list that we maintain at all times on StockCharts.com. And I do want to point out a couple things. We're going to talk about breadth a little bit later, but the bullish percent index is one of those indicators that we follow along with many others. This is based on point and figure charts. And we've had people like Bruce Frazier on the show, Ramon Bogomazov, that are sort of Wyckoff aficionados that have a point and figure component. They remind me how important point and figure charts can be to help you understand the overall dynamics. This has gone now below 50% to around 45%, which tells you 55% of the S&P members are currently in a bearish phase using the point and figure methodology. The last thing I want to mention, and then we need to take a brief break here, is the one of the key measures of offense versus defense. How are investors rotating from the offensive side to the defensive side of the consumer space? This is a ratio of consumer discretionary versus consumer staples. Even with the weakness that we've seen, overall, the ratio is still fairly robust, telling you that investors overall are still on the offensive side of the coin. When you take the market cap component, look at an equal weighted version, you see that's pulling back a little bit. Still not enough to register any sort of negative pattern for me, but certainly a chart I will be watching, because if these ratios start to rotate lower, that's what would confirm that investors are getting very defensive. Not yet, but certainly a chart to watch. We need to take a quick commercial break. We'll be back with today's guest, Marc Chaikin. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we recap the market movements using stock charts. Couple quick comments before we get to today's guest, Marc Chaikin. First off, we love to hear your questions. We are very interested in your feedback on our show, our hosts, our guests, all of the stuff you see on Stock Charts TV, but particularly your questions. What are you running into as you were trying to analyze the markets using the technical analysis toolkit? Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, do me a favor, go to StockChartsTV.com. That is our on-demand platform. Lots of great content every trading day, and special events like The Pitch, our year in review coming up later this month in December, our 2022 market outlook coming up in January, so much more. Go to StockChartsTV.com. Also on your mobile device, just search on any of the app stores for Stock Charts TV on demand. I want to welcome on today's guest, Marc Chaikin. Marc's the founder of Chaikin Analytics. If you use technical analysis and if you use some of the technical tools that we have added to the Stock Charts platform, chances are you're using something that Marc either created or pioneered or certainly popularized. And Marc, welcome back to the show. It's good to see you.
David, it's great to be with you.
So we have this situation where we've had the market has been in an incredible uptrend for much of this year, much of 2021, sort of a choppy environment, increased volatility, and now we're in sort of a pullback phase of sorts until today when we start to bounce higher. We're starting with the McClellan oscillator. How are you making sense of this current market?
I'm seeing this as a great buying opportunity, and this chart that you have up has been one of my go-to indicators for the last 2 years, and it's worked going back 5 years. whenever you get a washout, which is typically associated with 2,000 declines, net declines on a given day, this indicator will drop below 60. And if you look on the chart, every time you've gotten to that 60 level, and I love that CCI, and this was a default chart in StockCharts, you can see that you bounced up sufficiently to go from oversold on a breadth basis to overbought on a short-term basis. So the setup is compelling for me. Now, if you look back in March, obviously, if you're in a bear market or in a really corrective phase, 15 to 20%, you're not going to get that immediate bounce. That's why I look at the next chart that you're going to put up to put this in perspective. And here we're looking at the percentage of stocks in the S&P 500 above their 50-day average. And you can see that that gets oversold a lot less than that short-term breadth indicator. So when you combine the short-term breadth indicator with that RSI of the percentage stocks above their 50-day average, that tells me you're going to get a significant bounce. And that coincides with my view that the market was going to rally into year end.
And I would say, right, when we see this weakness that we've seen, it's really fighting the seasonal trends, which tend to be fairly strong, right? Going into the end of the year, the Santa Claus rally, all the things we tend to talk about. And you've highlighted, I think, very, very well how some of the weakening patterns in this indicator line up with some of the previous pullbacks. When you're looking, Mark, then if you do see strength and if this is a buying opportunity, where are you looking opportunistically? Is it an area like financials or something that had a really good run and have shown some weakness, or is it something like tech, like semiconductors that are just have shown strength through this corrective period? Where are you looking now?
I'm looking at stocks and more particularly themes that have basically gone on sale here in the last week. So cybersecurity. I mean, cybersecurity is going to be a problem for the next 10 years. I'm looking at electronic vehicles and batteries where you can find, and even the autos like Ford and GM, but any place you can find stocks that have basically taken a haircut. And if you look at some of the really interesting growth names, they were down 10 to 15% intraday yesterday in many cases. So one of my favorites, I don't know if can we talk about an individual stock?
If you are up for it, I am okay with it, Mark.
Yeah, Fortinet has been a favorite of mine for the last year. And if you look at the intraday action in Fortinet yesterday, the stock basically went on sale.
Yeah.
It was down 8% on the day. It had a 10% intraday dip from high to low. You can find a lot of stocks like this. I'm also interested in solar. I think these are three themes that I'm very interested in, not for the next week or the next month, but going forward for the next 3 years. And I have basically shifted from a short-term mentality to a longer-term mentality because of the volatility that we're seeing. I think to conquer volatility, you have to have a plan. And for me, the plan is always based around themes. And I like your theme about the reopening travel play. Very bearish on the airlines as well. But even in that sector, you've got a stock like Live Nation, which had a great earnings report. Kids want to go out and party, go to concerts. They're not going to be stopped by a new variant. And Live Nation is on sale. It dropped from 125 all the way down to 100 the other day. So this is what I'm looking for, just bargain stocks with great stories.
Mark, what I love talking about you, it reminds me, this is a compliment, talking to a lot of the investors I would work with at Fidelity. In an environment like this, when the market had pulled back so suddenly, I would naturally get a little anxious because I'm looking at the charts and seeing all the red. Some of the money managers would be super excited thinking, these are great companies on sale. This is a bargain environment. This is perfect. So you're right. Could be some interesting opportunities. Mark, listen, it's so good to see you. It's awesome to have you on the show. I wish we could spend much more time, and I look forward to more opportunities to do that in the new year. But be well and stay safe there. Okay.
You too, David. As you said, 5 minutes goes by very quickly.
Take care, Mark.
Be well.
That's Marc Chaikin. Marc's the founder of Chaikin Analytics, and many of the indicators that you probably have seen on StockCharts, things like Chaikin money flow, accumulation distribution, all really popularized and created by Marc and his great work over time. I did want to mention we're super excited to be partnering with Chaikin Analytics on a number of things. You can see one of Marc's analysts, Pete Carmesino, who hosts a show called Halftime with Chaikin Analytics every week on StockCharts TV. And also there's an ACP plugin that Marc has helped us design using the Chaikin Analytics Power Gauge stock rating. They're running a special in December, just like we are for the holidays. I encourage you to check that out. It's a great way to illustrate the relationship of the technical, the fundamental, to have a more holistic view of a particular stock and position. You can find that in our ACP plugin environment. We need to continue on today's show with our next segment called Getting Sentimental. Let's focus on some of the sentiment readings. A lot of those update on Wednesday into Thursday every week, and I like to check in on those and focus on some of the messages that sentiment can provide. And as a reminder, I tend to think of the big picture in three parts. We have price, breadth, and sentiment. That's sort of the priority order that I've always found. And again, in my experience, at the chart room in Fidelity, very, very similar. We would always start with price, focus on the price. The price tells you much of what you need to know to understand the market environment. Reading books by John Murphy early on, reinforce the value of price, the information that is embedded in price itself. Second to that for me is breadth, and using techniques like Greg Morris and others have popularized, Tom McClellan and many others, to visualize market participation. Look at the individual stocks that make up those indexes and what those all are doing, what message you can get from that. Third, but still very important, is sentiment. So we had a famous chart in the Fidelity chart room looking at magazine covers and thinking about contrary opinion and when a major publication would pick up on an investment theme. So this is an exercise in market sentiment and contrary opinion. What signals can we derive? And let's look at these charts together. We'll start with the VIX. I always like to start with volatility. And, I've mentioned with a number of my guests in recent months, this volatility regime. 2019 was a period of very low volatility where the VIX tended to range between 10 and 20, really. 2020 completely blew out where the VIX got above 80, and it was a huge change of character for volatility. And much of 2020 and into the beginning of 2021, you saw elevated volatility. So the VIX back here in January of this year was up around 37. From there, we've spent the last 6 months in a relatively mid-range volatility regime, if I can describe it that way. The VIX has a number of times bumped up to 15 or bumped down to 15, which is when the market has often cooled off a bit. It's spiked up a number of times above 20 to 22. And that's where you've seen these spikes in May, in June, July, August, September. These have coincided beautifully with these pullbacks in the S&P. So when Marc Chaikin was showing his chart with the breadth indicators like the McClellan oscillator, the percent of stocks above their 50-day moving average, and lining those up, you can see how they line up here very well with spikes in volatility. It tends to be a very similar idea, and they've tended to be very buyable dips. So here, where we have the VIX spiking up to the second highest level so far in 2021, here in the low 30s for the second time this year. Overall, Marc's argument is that we've had a period of high volatility, a pullback in price. This is an opportunity to ride the next leg higher, and I'm inclined to agree with that assessment. Overall, I think you tend to think of these pullbacks as buyable pullbacks, as opportunistic opportunities, as opportunistic plays to get back into particular names until proven otherwise, though. And that's why I think risk management and thinking of your downside protection, even with opportunities you take advantage of now, super important. So the VIX overall is incredibly high. It's similar levels, elevated levels that have been buyable dips previous in 2021. Let's look at sentiment using the AAII survey. And what we notice here is that the bulls are actually very similar, right? You have 26%, 27% on the bullish side, but the bears have actually increased, going down to 42%. Obviously, this is a pretty good reaction to the sell-off that we've seen. The spread between bulls and bears is relatively low. This is similar to what we saw in early September when we had an initial pullback off of the August highs, and it's a similar range to where we were in the first half of 2020 when we had the sell-off, and then you had this recovery period, and there was a stretch of disbelief where bears outnumbered bulls. That didn't change until October of last year, if you can believe that. Now we're seeing the opposite, right? We see a fairly elevated sentiment picture with bulls outweighing bears fairly consistently. That has changed now in the last couple months, with September seeing a net bearish reading, and now in November into early December seeing a net bearish reading as well. So overall, we're seeing the most bearish reading from this survey than we've seen since September of last year. I think that's worth noting. We also are seeing a relatively low number of bulls, and that is something to certainly pay attention to as well. Market tops tend to coincide with elevated bullishness. We've alleviated those conditions and now rotated to a little more of a bearish posture in that survey. I did want to highlight a couple other charts here. The Name Exposure Index, which is a survey of money managers and asking how they're allocated to the equity space, currently came in this week at 88%. Now, for the last 5 to 6 weeks, we've been around or just above 100% long, which has been net leveraged long. That tends to be at the later stages of a bull market cycle. Money managers sort of get all in, and at times can be a bit of a warning that the market is a bit overheated. That condition has alleviated. Now you're no longer getting that euphoric reading. You're getting more of a mildly bullish reading. This is more in the upper end of that normal level for a bull market environment. This is certainly an indicator to watch to see if money managers in subsequent weeks continue to tap the brakes and take some of their equity bets off of the table, or if you would see an increase where money managers are buying in on this dip and this opportunity. The RIDEX flows, by the way, remain at some of the lowest levels we've ever seen, implying that within the RIDEX family, investors are certainly on the more conservative side of the coin. I wanted to finish off just with the put call ratios. So these are ratios looking at the put call, looking at the options market and volume on the put call versus the call side, and oftentimes can be an interesting contrary view. You can see that spikes in the put call ratio, particularly this current level, which is the horizontal line here, showing you the current level and how that coincides with previous spikes in the put call ratio. You can see this is lined up with the May pullback. The other times we've been this high have been in the August pullback, the September pullback, into October, and where we're at now. So now granted, right, in September, you got to this level and then continued even further as the pullback sort of continued. I wouldn't be surprised if we don't get just a V bottom of sorts, but if this is a little more protracted. Remember, markets can correct in time and or price. That's something to watch for on this chart of the put call ratio. Do we see something similar to what we saw back in September and October of this year? That is Getting Sentimental, focusing on some of the sentiment readings. We need to wrap today's show and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is a different breadth indicator than we talked about so far in the show, the new highs and new lows. I've often said during a bull market phase, you will expect, or you should expect, an expansion in new highs. So going back here in September, October, you saw the market had pulled back, and all of a sudden you started to see an increase in the number of the new highs every day. You saw very few new lows, and that told you that even though the market was still holding down a little bit, you saw a lot of individual names that are starting to recover quite nicely. That is the sign of a healthy bull market phase where you find more and more stocks making new 52-week highs. That has changed. Now all of a sudden you're seeing a decrease, a drying up, an evaporation of new highs, and you're seeing an increase in new lows. That is not what a bull market phase is made of. This is actually the strongest negative reading we've seen in the new highs, new lows indicator in terms of an absence of new highs and an increase in new lows since February, March of 2020. So it's a fairly strong rotation from stocks making new highs to stocks making new lows. That is absolutely a chart to watch, because if you do find some stabilization to rotate higher, that chart's going to have to rotate higher as well. Chart number 2, I mentioned yesterday what I call the ASH trade, ASH, A for Apple, S for semiconductors, H for home builders, ITB, which is the home construction ETF, threatening a new high. I think it made a new closing high for the last 52 weeks today. On an intraday basis, I don't think it quite made it, but a new closing high today, the relative strength making a new 6-month high. I have to remind you that even when the market is a scratch the head question mark type of market and you're wondering whether to buy pullbacks or not, remember that some stocks and some charts are just working. And in general, owning stocks where the relative strength is improving and not owning stocks where the relative strength is going down has tended to be a fairly effective approach. Finally, when we're thinking of actionable ideas, I'm looking at something like DFS, Discover Financial Services. It's a group of a number of financial stocks that have pulled back quite a bit. It's broken down through its 200-day moving average, downside potential to that first Fibonacci level around 92, which is the low from March and April. Do we see further downside or not? That is a chart to watch for a potential upside recovery. Folks, that is our show for today. Special thank you to Marc Chaikin from Chaikin Analytics joining us from the New York area. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.